right. Welcome, everyone. Thank you for turning in early. We will get started here in a few minutes once we go live on all the platforms. So thank you for tuning in early. All right. Looks like we got a few more guests on the live stream. Thanks, everybody, for joining us. We'll get started here in a few minutes once we go live on all the platforms. And today's topic, we will go over some specific examples of ground-up construction loans, some very cool options for investors as well as primary homeowners. So some cool options we'll get into. Let's give it a couple minutes here and we'll get connected. There we go. All right, looks like we're up and running. Let me get started. Welcome, everyone. My name is Nick Hiersche. I'm the president and founder of The Mortgage Calculator. We are a lender that specializes in alternative income documentation programs, as well as conventional VA, USDA, and FHA, all alike. We have over 350 loan officers and are licensed in 17 states for primary and secondary homes. And we can do the investor business purpose loans in almost all states. So a lot of great options. For today's topic, we'll do a deep dive into a very specific option. But first, we're going to start with the daily rates as we do every day. We'll go through the different options for conventional, for FHA, and then all of our amazing thousands of non-QM programs as well. And we'll go through a few investor options as well. In a little bit, once I'm done with the general rates for this morning, I'll go and check in with Jose and have him do a deep dive into our topic for today. And then Kyle will talk about how to connect with our team. So let me pull up my slide real quick. Today's topic is going to be on ground up construction loans. So these are a common request. They are very challenging, obviously, for anybody that's tried one. But we love to help our borrowers find solutions, right? So whether they're an investor trying to build a ground up project with a piece of land that they perhaps have invested in and produce some plans, or a primary homeowner finding a new place to live that's looking to work with maybe a new builder to build a spec home or something custom, which is another common request these days. So in this environment, it is a little bit difficult to do. So Jose will talk about the ins and outs of our different ground up construction programs here in a minute. But before we do that, we'll go over the daily rates live as we do every day. So today is January 31st, 2023. It's just after 11 a.m. And the rates are live now for all of our different loan programs. So let me pull up my rate tool here, and we can go ahead and check out the rates for this morning. So this is our pricing tool. This is a tool for our mortgage professionals. So if you want to work with one of our team members, please get with them to provide you a full loan estimate with all of the costs and details. This is a quick pricing tool just to give an indication of the rates and programs this morning. So just keep that in mind. We are licensed in 17 different states. If you would like a quote, please get with our team. And we can do the non-QM business purpose loans in most states as well for our investors, which will be our example later on the ground up construction for investors. But let's go ahead and check out what we have this morning. Our standard scenario that we're going to quote every day is going to be an 80 LTV purchase, which is going to be a 20% down payment. We're going to have price here of 99. What that means is we're going to look for the best option at a 1 discount point in cost. Typically, our borrowers, since it's a little bit higher rate environment here than most like it to be, obviously, they're looking for a little bit of discount points. They can finance that often through a seller credit or something like that. But typically, most buyers want to see something with a little bit of buy down and sometimes even get aggressive with the temporary buy downs. But we'll go ahead and set this at 1 discount point for all of our examples. We're going to go through a few examples for conforming conventional, FHA, and then we'll step into our expanded guidelines for our non-QM programs. We have VA we can quote instantly as well, but that's only for our veterans who have served and are eligible. So if you are eligible, please get with our team members. I'll quote that up in just a couple minutes. And with USDA, that's only for rural properties. So if you have a rural property you're looking at, please give us a chance. We'll quote it up in just a couple minutes, but we won't go through that today on the show. So our first example, we'll do conforming conventional purchase, 30-year fixed, pretty standard scenario, primary, single family, 1 unit in Florida, Miami-Dade. That's where our office is based. We're going to use an estimated 760 FICO and an estimated debt to income ratio of 40. And we can go ahead and check out the rates for this morning. Remember, it's January 31st. And let me get through the security check here. Hopefully that worked. And here are the rates for this morning. So we have some rates for Home Possible and Home Ready. These are specialty programs for borrowers who may be under area median income or in a census tract. So let's cruise down to the standard, just because those don't apply to everybody. Let's see what our first conforming 30-year fixed option. So we're at a 6% rate for just under 1 discount point. So rates went down a little bit from yesterday. That's why we love doing this show. Yesterday was a little bit higher for a standard primary purchase. Today the rates went down a little bit. So again, we love doing this show. Check out what the markets are doing and get with our team, and they can send you the full breakdown on these different options for your exact scenario. But now let's go to our other most common scenario. So if a borrower maybe doesn't qualify for conforming or conventional, usually the next option to go a little bit more expanded guidelines, as we call it. Maybe we need a little more debt to income ratio to work with. We can use the FHA programs. So if we do the same scenario, everything else staying the same, we're going to keep everything equal and compare this to our FHA. So our FHA this morning looks like our top program here. Best combination, 5.375 rate for exactly 1 discount point in cost. And keep in mind with FHA, there are additional mortgage insurance costs. So always compare the APR. That way you compare apples to apples on FHA versus whatever other program you're comparing them to. We have a ton of FHA options. There are some crazy programs like the disaster programs, the 203K. So if you want to go through some of those other alternative FHAs, please let us know. We can quote those as well. But now, this is where we get excited here at the Mortgage Calculator. When a borrower maybe doesn't qualify for conforming or FHA, a lot of lenders or banks are stuck. They do not have non-QM programs, and that's where we love to shine. So we have thousands of expanded guideline options that go beyond conforming conventional and beyond FHA to allow borrowers who may not qualify for either to still get the home of their dreams. So in this example, same 80 LTV purchase, 1 discount point, 30-year fixed, single family Florida. Everything else is going to stay the same, but under our expanded guidelines, we can change our income verification. So instead of full doc like we did with our FHA and conforming, we can use all these different options. 1-year alt doc, 2-year alt doc, asset related. We did that on the show a little while back. Business bank statements, 12 and 24 months, very common, but we have a ton of options. Investor Dscr, that's our favorite product. We'll talk about that in a minute. And we have personal bank statements, 12 and 24. Those are probably our most popular products. So for the example today, we're always going to use a personal bank statement, 12 months. That's our most common request for someone who may not qualify using their tax returns, but they make plenty of income because they are self-employed. And we can prove that via 12 bank statements to determine a debt to income ratio of 40 for that borrower. So using bank statements and using that analysis, we can see that a borrower who may have written some things off on their tax return or it doesn't quite work on their tax return, we can prove that they still do make great income and determine that they can repay that loan. So let's check out our options under bank statements for our self-employed borrower. Now, these rates are going to be higher, but remember, this would be a borrower who would not otherwise be able to get a home. So great options here under 7% for 1 discount point. Looks like 7.375 for a little bit less. So a ton of options. We got hundreds and even thousands of these different options under our non-QM guidelines. Remember, every one of these programs differs. So you make sure you get with our loan officers to see which one might fit with you. When we're going expanded guidelines under non-QM, we can also get around such things as credit events. So some of these programs may allow a credit event like a bankruptcy or a short sale or a foreclosure or something else like that. So a lot of great options we have here under the non-QM please get with us. They do vary in rate, cost, and all that kind of great stuff. So a lot of options. That's where we love to work with our borrowers and make their dreams come true where they might not otherwise qualify. Now we'll switch gears. Before we get off the live rate pricer today, we want to check out our investment options. So here at the Mortgage Calculator, we love to work with investors, whether they're first-time investors buying their first rental property or an investor that maybe owns 100 properties and needs to refi and purchase more or whatever it may be. So for an investment property, our options are only going to be conforming conventional or some of our amazing expanded guidelines non-QM programs. So first, we'll check out our conforming options. 30-year fixed, 80 LTV, same thing we did before. This time is just going to be an investment property. Now remember, the Fannie Mae, Freddie Mac, the government entities that insure conventional loans have added an additional loan level price adjustment, aka a penalty, to investment properties. So while we'll see some great rates, 6.625 is great, you do see that these ones do come with additional costs. Our computer was not able to find a program that had one discount point in cost. The least expensive program here is 2.75 in discount points for 6.625 rate. So a lot of our investors are asking for how do we get other options for less discount points, because investors want to typically save cash out of pocket so they can invest in other properties. So there's obviously other options, but none of them go high enough to really reduce these discount points. So common request that we have, we can satisfy by pulling this back up, putting our expanded options, our non-QM options for investment property, and we can choose all of these different non-QM income types, but our favorite by far here, and the one we love to do on the show, is our investor Dscr option. So this actually doesn't require any income. This is just using the rent income from the property in order to determine a debt service coverage ratio, or DSCR. That allows us to determine that the rents will cover the PITIA of the property payment and allow us to do that loan as a business purpose loan. For these non-QM programs for investment properties, non-owner occupied, we typically have a prepayment penalty built in. So we're going to price this at 3 years. There are options for 0 and there are options for 5. Obviously 0 will cost more. 5-year prepay will actually reduce the cost for the investor. So a lot of different options. We're typically going to use 3 years in order to just pull up a scenario. So this is one of our most common requests, and we'll see here the rates are going to be a little higher, but in this case, we're going to have much less discount points. So our best option here at 8.25 rate for 0.6 in discount points. That's much, much lower than the conforming conventional options were. So our investors are able to save money, not have to use any documentation for income and prove any income whatsoever, and they're able to do these very quickly and do multiple applications at the same time. So our example of an investor that has 100 properties, we can refinance 5 or 10 of them in order for them to purchase 5 or 10 more or what have you. So these DSCRs do open up options beyond just buying down the rate a little bit more effectively for the investors, but they allow us to do multiple properties. So we absolutely love to do these DSCR programs, and it opens up a ton of options for our investors. Now, let me go ahead and take off the live pricer. And I'm going to let Jose take over in a minute. For those of you who just joined us, let me introduce the topic for today. And I'm going to let Jose talk about it. So we just went through the live rates. Again, today is January 31st, 2023. So those were the live rates for today. We always love to do a deep dive into a program as well on the live show. So what we've had is Jose Gonzalez, our sales manager with 27 years of experience, has gone through, set up a couple examples for ground up construction loans. So these are going to be options for our investors, typically invest in a piece of land and have some plans and need to finance the construction costs, obviously, of the product. And then once the project is done, we can usually refinance into more of a DSCR loan, like we just went through an example. But the very hard and difficult part here are the actual ground up construction part of the quote. So I'm going to have Jose explain a little bit more about this, and then he can actually share his screen where he's got a example set up. So let me pass it over to you, Jose. Go ahead and take over.
How's everybody doing today? Thank you for joining us at the Mortgage Calculator for for our live rates. Ground up construction today, a very interesting topic, especially considering that what's going on with the market, with inventory, all these other factors that are happening, makes new finding an existing home a challenge, and obviously has resulted in a lot of spec homes going up. So what we're doing today is showing you how easy it can actually be for an experienced investor, because the main thing on the ground up construction is that they typically require the investor to have either heavy rehab experience or previous ground up construction. And what we're talking about here, when we're talking about ground up construction, now we're talking about a spec home, something being built by an investor to resell, as opposed to when you're building the home for yourself using a contractor and it's going to be a primary or second home. In this scenario, we're just talking about the investment home. Right. So the other thing to consider with these ground up construction scenarios is that the investor experience that we're talking about is experience with the deal. Right. It's not like, oh, I built 5 homes as a contractor, I have ground up construction experience. No, what they're talking about is ground up construction experience with the deal, from the purchase of the lot to the processing of the build to the eventual sell, or the eventual keeping the home, and maybe you're putting it into your own name and you're going to keep it as a flip and hold, as opposed to a fix and hold, as opposed to a fix and sell. Okay, sorry about that. See, we seem to be freezing here a little bit. Let me share the screen here a minute so I can get into the, hold on a second, so I can get into the deal. Let me just preview this a minute here. All right. Okay, so I got my deal up here on the screen. All right. So what we're looking at here in this deal is a purchase of land that costs $200,000, right? So it has an as-is value of $200,000, and it has a purchase price of $200,000. And in this example here, we have a rehab budget of $250,000, and we have soft costs of $35,000. And as I mentioned earlier, before I proceed, this investor has 5 ground up constructions in the last 3 years. So that's really important to note, that, because that's, if he had 1, he probably would have less options. So here 5 is a nice number. So we also have a financed interest reserve of $22,397.91. So in this case, we are prepaying upfront, included with the loan, the actual payment for the property. So I chose for my scenario to fund the interest reserve from the loan and not out of pocket. That's a real important note to consider there, because that's really, the investor doesn't want to be bogged down with worry about having to make the interest payment. Neither when I'm talking about investor here, I'm talking about our actual builder, and neither does the lender want to worry about the builder having to make the payment. So they want that money up front so the builder can just concentrate on building the home as soon as possible. So they give us a couple of different options. They give us our initial loan amount, which is the initial advance plus the rehab budget. So our initial advance rehab budget total is $389,852. So that's what they're going to give us up front. And then there's a little bit left over there because our maximum amount is $412,250. But here's where it gets interesting, right? Note that the down payment is $95,147.91. That's very interesting because we have a $200,000 purchase price and $285,000 in rehab budget, right? And they're asking us to only put $95,000 down, and then our closing costs and origination. So total estimated loan costs of $116,000, $116,348.78. Let me put that down a little there. So that's our total estimated loan cost for this scenario. And then they require a 10% liquidity check. So, that's basically reserves for 10% of the max loan amount, which is 412,250. So our 10% of that is 41,250. So our total estimated liquidity, that's what they like to call it, liquidity required, what they got to verify. And you have to give 116,348 at the closing, and then you got to show 41,250 as reserves, is 157,573.78, which is excellent because, as you know, normally buying that land, if you're just going to buy that land on its own, it's going to be either a cash deal or it's going to be 50%, 60% down payment, and then a very short-term bridge loan while you will wait to do exactly what we're doing right now, purchasing the land with the rehab and with everything included. Now, the one thing to note when you do get into these loans is you have to be ready. I mean, it looks great on paper, but to get to this point, the investor had to do some work. He has to have his contractor in place. He has to have estimates. He has to have plans. They're not going to give you a ground up construction loan when you're going to start from scratch, because it's just going to take too long. It could be 3-6 months a minimum to do this type of planning that would be able to get you where they are right now with having like approved plans and everything. During the pandemic, they were even asking you to have the permits already pulled and approved because it was taking so long to get that done. So depending on the scope of the project, they may or may not require that, depending also the area where it's at. But that is something to consider. But main point is here, you have to have all of your items lined up to be able to jump right into the project, because it's pretty obvious here, time is of the essence. Time is money. They give us 12 months here is this structure on this loan. I mean, you can do them for longer. I just opted for a 12-month quote here because my builder and my investor, they're all really good. They're already quick. They've already done this house, this model in other spots. That's why they have this approved plans already. And they're locked and loaded, ready to go. So where you're going to get in trouble is where they don't have any of the documentation ready, then they're just not going to approve your loan when that happens. But if you look at the deal, this property has an ARV of $700,000, so if we go a little bit lower there, look at our total cost and look at our profit. $212,560. I mean, probably you got to go through the numbers and fine tune the actual gross profit, but it's very, very. Here we go. Let's show this analysis right here. So very interesting there. Now, obviously, rates 12.31, but again, that's a 1-year loan. The interest is prepaid already, so that's just the vehicle. So you can make the $212,560 profit. So, what money did this investor really shell out of his pocket? Down payment, closing costs, and then he's, if the deal is right, they're gonna get all that back. So look at this is the numbers that the investors love. Look at the loan to cost, 84.57% loan to cost. That is,
we can even take that up to 90, I believe, right, Jose, if the deal's right.
Yeah, if the deal is right, if it has a little bit more meat on the bones, They're going to give it to you. Critical component there again, obviously, is the investor experience. The more experience they have with the ground up constructions, the better rate they're going to get, the better terms overall that they're going to get. But I mean, any investor would jump on this deal. I put $250,000 for bills, so that's going to be what, like a 2,000 square foot home or something like that. So very, very nice situation to consider here. So, all right. So that's pretty much it with the example there.
Oh, it looks like you're muted, Nick.
Yeah, let me go ahead and toss it over to Kyle, who can close us out and explain how to connect with our team.
Thank you, sir. Yeah, absolutely. So as Nick stated earlier, we are licensed in 17 states, and then we can also do our business purpose loans like the Dscr loans that Nick went over in the pricing tool in most states, right? So we have over 350 loan officers, so we would love to connect you with one. If one of our loan officers is the one who shared this video with you, definitely connect with them, and within a few minutes, they can give you a personalized quote like Nick went over here. So if you're not working with one of our loan officers already, feel free to go to the website, themortgagecalculator.com. It's also right here. And go ahead and submit, and we can connect you with one of our loan officers. Now, one thing to note is our loan officers do not just do conventional FHA, VA, USDA like most loan officers do. Our loan officers are trained to go above and beyond and be loan consultants. They can walk you through what program is best for you, ranging from conventional to these bank statement programs that Nick went over and the DSCR asset utilization, as well as the fix and flip in commercial and the ground up construction that we went through today. So definitely reach out, themortgagecalculator.com, so we can connect you with one of our loan consultants. We also do this every single morning at 11 a.m. Eastern time. Every weekday, we pull up these new rates, go through the rates for that day, and then do a deep dive into one of the products. So definitely tune in tomorrow, 11 a.m. Eastern time. We will see you all then. Thank you for tuning in. We'll see you tomorrow.
Thanks, everybody.
Take care, everyone.